Hi everyone, welcome to episode 12 of Learn on the Go. And today I want to talk about a company that operates in a sector with thousands of competitors. This one's an NBFC, one of 9,000 plus registered with the RBI. And I'm sure some of you are wondering, ऐसा क्या देख लिया शंकर ने इसमें? I'll come to that, but on the face of it, a lending business looks very easy. NBFCs borrow money from different sources for which they pay an interest. It then lends this money to someone who's charged a higher interest, and this person or company is expected to pay back the interest and the principal on time. Of course, not everyone is able to pay or is willing to pay back, and that's basically the business model. So it's a sort of arbitrage play with some rough edges, especially the NPA wala part. Now, imagine a NBFC with zero NPAs. Yes, you heard that right, zero NPAs. And one company that operates in this environment is SG Finserve Limited. Something these guys are super proud of. This is the balance sheet and a zero NPA record since inception. This one's the investor presentation. Gross NPA is nil. Earnings call. There has been zero NPA. I am again repeating zero NPA. And also credit rating reports where it says the asset quality indicators have remained good so far with nil NPAs till September 30th, 2025. Seeing all this, it does make me wonder whether we should be calling SG Finserve an NBFC or not. It's one of the many questions I have. We'll definitely come to it. But I want to start off by thanking PowerUp Money for supporting me on my YouTube journey. PowerUp Money is a trusted mutual fund advisory app that's made mutual fund review, selection, and rebalancing absolutely simple for investors. I'm myself a heavy user of the app. I have like mutual fund schemes in my portfolio. So this really helps me, and I thank them for trusting me and for inviting me on their journey. Okay, let's learn more about SG Finserve. This company was established in 1994 as Mungipa Securities Limited. But the real story starts in 2021 when a couple of guys, Rahul Gupta and Rohan Gupta, they acquired a majority stake in Mungipa, which was soon followed by an open offer. Then in July next year, 2022, the company's name was changed and it's now SG Finserve Limited. Rahul Gupta, Rohan Gupta, RG. I'm sure some of you must be wondering, ये RG के बीच में ये SG कहाँ से आ गया भाई? So SG here I think is Sanjay Gupta. He is the chairman and managing director of APL Apollo Tubes. Rahul and Rohan are his sons, and as we go along, this connection between APL Apollo and SG Finserve will become more visible. So in September of 2022, the company restarted operations with a focus on supply chain management. I still haven't shown you the disclaimers and the disclosures, so here goes. I'm sure you know it by now, but I am a SEBI-registered research analyst. I do own some shares in SG Finserve Limited. Not much, just a few. I haven't received any compensation from the company to make this video. Just read through everything here, and obviously remember, anything I say or show in this video is for educational purposes only, and none of it should be construed as a recommendation of any sorts. Okay, let's continue, and a relevant follow-up question is, what is supply chain financing? Let me explain it with an example. So say there's this big famous toy factory that makes all your favorite toys. These are then sold to smaller toy shops all over the country. The orders are generally small, but sometimes one of these toy shops wants to place a large order, perhaps anticipating that these toys will sell well in his region. And as is often the case, it doesn't have enough money upfront to make that purchase. But like any smart businessman, he does not want to miss out on this opportunity. So what does he do? He goes to a lender who, like a nice friend, steps in, provides the toy shop the money he needs to buy toys from the factory. So the toys are bought, the toys are sold, the cash comes in, the toy shop repays the lender, and that's the cycle. It's a win-win-win for all three stakeholders. That is, the big factory does more sales, the small shop also increases income, and the lender gets interest on the money that it has lent out. So this is standard supply chain financing. It's a big market in India, with just SG Finserve having dispersed over 52,000 crores in loans over the past 3 years. Of course, this is not the only player. There are banks, other NBFCs, private financiers, fintechs, etc. A lot of competition. And in that context, it is important to understand what SG Finserve is doing differently here. Two things really, and a lot of it goes into the core of the company's business model. So firstly, SG Finserve is talking directly to the big toy factory. And by talking, what the company wants to know is, A is the small toy shop selling a lot of toys, which can be easily figured out by examining the purchase orders. And secondly, are they paying the big toy factory their entire outstandings, and are they doing it on time? Now, if the answer to both these questions is yes, then SG Finserve, or for that matter, any lender, would be very comfortable doing this transaction. So essentially, the company is trying to determine risk here by using the transaction and the payment history. All right, the second thing that adds a lot of weight to SG Finserve's business model is how it uses its connection with the big toy factory. And what is this connection? Well, think of it like a promise that the factory makes to SG Finserve that if the little toy shop does not pay back the money to the lender, then the big factory would stop supplying any more toys to it. Obviously, this is not a situation the smaller shop wants to be in. And the stop supply clause, which is kind of a threat, is what pushes the shop to fulfill its repayment obligations in a timely manner. So these were two important cogs of the business model. Firstly, an understanding of who and how credible the borrower is, and then the stop supply arrangement that ensures the borrower does not try anything naughty. One can also call it a moat, actually two moats, and it explains why this NBFC operates at a much lower credit risk as compared to other MSME lenders. In fact, the management views supply chain financing as a superior product when compared to a traditional cash credit or overdraft facility, on the simple premise that supply chain offers more control over the end use of funds. I kind of agree with this. In this case, every rupee that SG Finserve disperses goes directly to the anchor, to the corporate's account, and only post the confirmation does the anchor supply materials to the dealer or retailer. This is not the case with CC or OD. They are more open-ended in nature, and the borrower is free to divert the money for any purpose, which increases risk within the transaction. A third moat, or let me call it a semi-moat, is SG Finserve's association with the APL Apollo Group. As many of you know, APL Apollo is India's largest structural steel tubing company with a nationwide distribution network and annual sales of over 20,000 crores. This association gives SG Finserve a bunch of advantages, including credibility, an initial base of channel partners, and strong financial flexibility, which includes corporate guarantees from the parent company. One can even argue this company was primarily formed to cater to the funding requirements of APL Apollo's dealers and vendors, but with more anchors joining in, this number has been brought down to somewhere around 40%, with only 10-15% of all incremental business coming from the APL Apollo Group, while the rest is happening outside the group. In fact, as a strategy, SG Finserve targets the industry leaders, the top 2-3 companies in every sector, and in terms of segments, there are essentially 3. Building materials and construction, APL Apollo, Polycab India, Saint Gobain, Kajaria, Tata Steel, etc. Then there's the automobile segment, which has 20% exposure with clients like Tata Motors, Mahindra and Mahindra, Ashok Leyland. And another 20% is IT and peripherals with Oppo, Redington India, Ingram Micro, etc. The number of anchor partners has been growing steadily. It was 48 as of Q1 of this financial year. And in terms of commitments, some 6,500 crores worth of MOUs have been signed, which augurs well for the top line growth of SG Finserve and the sector as a whole. A fourth moat, which I believe offers a rather significant competitive edge to SG Finserve, is their technological and digital capabilities. If one looks closely, there are 3 parts to this. Firstly, there's risk mitigation, and this is where the NBFC platform is directly integrated with the anchor's ERP system, which takes care of invoice disbursements, the dispersal of funds, stop supply arrangements, analytics, borrower scoring tools, credit monitoring, etc. Then comes the core digital platform covering the entire customer journey from origination to collection. And thirdly, the digitization of the entire workflow gives SG Finserve a key competitive edge in terms of speed, cost, and agility compared to traditional financial institutions. While the replication of technology is definitely possible, the fact that banks and larger NBFCs often lack a singular focus on supply chain financing is what makes it a strong moat for companies like SG Finserve and other players within the segment. All right, now let's look at the financials. And unlike manufacturing companies or some of the other service companies that I've done in the past, SG Finserve and NBFCs, they have very different metrics that one needs to consider. I mean, the original format, the original structure is still there, which is income minus expenses is equal to profits. But then there are a few more numbers and metrics that come into play. Let's start with the AUM, assets under management. SG Finserve started off aggressively on this, and the momentum has largely continued with the loan book reaching 2,878 crores as of September 2025. And although this image here doesn't show it, FY25 was a particularly difficult period for the company. Okay, so see this. So these 3 quarters, March, September, and December of 2024, actually saw a degrowth on account of regulatory hurdles as the company waited on its conversion from Type 1 to a Type 2 license. This approval was finally received in October of 2024, and since then, SG Finserve has shown remarkable recovery, almost doubling its loan book in a single quarter. As it stands, the company is targeting 3,500 crores for FY26 and an AUM of 6,000 crores by FY27. These are definitely aggressive targets, but the company is confident of achieving these on account of the scale of opportunity, the anchors that have already joined in, those 6,500 crores of committed MOUs, and the company's planned expansion into tier 2 financing, wherein not just the distributor but also retail invoices are financed under ongoing arrangements. Now, the reason I started with the AUM and the variability of it is to connect it with the company's income and profitability. For instance, let's go to quarterly data and see this. After 6 quarters of increasing revenue, we can see a degrowth that happened in June of 2024, September of 2024, and December. So these 3 quarters, when actually the company did very poorly, this was entirely on account of the regulatory hurdle that we referred to earlier. And now that that part is resolved, the loan book is back on track, and this can be seen in an increase in revenue for the last 3 quarters. This change can be seen in terms of profitability as well. So the operating profit, financing profit, so that's going up. And also in terms of PBT, profit before tax, the part of the company, even the EPS. But I must say, especially when it comes to NBFCs, one has to think beyond standard profit metrics and one has to look a little more deeper into the numbers. For example, a common metric is return on asset, ROA. And as a formula, this has the net profits in the numerator and the average total assets in the denominator. I found this slide in SG Finserve's investor presentation that explains the ROA tree, which I think is important for all of us to understand. So the first entry is interest income. It says here 11.5%. Okay, let me use the calculator. So this is 72.63, this number here. And we divide it by the average loan book, which is 2526. And then we have to multiply it by 4 because we're trying to analyze this number. So this gives us 11.5%. This is exactly what we have here, 11.5%. And I think the company has cleverly avoided showing quarter on quarter change in the ROA tree, because if one were to do the same exercise for Q1 of FY26, so 64.8, okay, 64.8 divided by 2096, the entry here, multiplied by 4, it gives us a ROA of 12.4%. It is much higher than the 11.5% that showed up in Q2 of FY26. Same way, the ROA for Q2 shown here is 4.5%. While when I calculated the ROA for Q1 separately, it came to 4.7%, which is very close to 4.5, which kind of gives us the impression that the company is consistently able to do an ROA of around 4.5% or thereabouts. Okay, let's go back to this number once again, 11.5%. And another way of saying this is by using this term yield. So yield is essentially the revenue, the income earned by the company on its loan book. From this yield, every lending institution deducts the cost of funds, which gives us the spread of that business. For SG Finserve, from the exercise we did earlier, the calculated yields for Q1 and Q2 were 12.4% and 11.5% respectively. And per their latest earnings call, the company's cost of funds for Q1 was 8.25%, while that in Q2 was 8.5%. So effectively, SG Finserve spread for Q1 comes to 12.4 minus 8.25, that is 4.15%, while for Q2, it's a lot lower at just 3%. Understandably, the wider the spread, higher is the profitability, and this is yet another metric that existing shareholders and prospective investors should watch out for. The management team wants to maintain a lending spread of at least 4% at all times, with an ROA of 4.5 to 5% and yields of between 12 and 13%. Okay, now that we've done the ROA, let's spend some time on the last metric, that is ROE, or return on equity. As a concept, the DuPont analysis applies here, which is a method of breaking down the calculation of ROE into its core components. However, in this case, we'll be using a rather simple shortcut, that is ROE is nothing but a product of the ROA and the equity multiplier. This equity multiplier is simply the gearing or the debt equity ratio, as we normally call it, plus 1. To make this part absolutely clear, let's try it for Q2 of this financial year. To compute the equity multiplier, let's take the debt on books, which is 1,897 crores. Let me open the calculator. So 1897. Now this number has to be divided by the equity. So this slide has the equity as well. This is 1071 crores. So 1071, which gives us a gearing of 1.77. So as the formula said, it's 1 plus the gearing. So that's plus 1. I should not have done this. 2.77. And very simply, we have to multiply this number with the return on asset. It's very conveniently given here, 4.5. So let's multiply it by 4.5%. And what we now get is 14.5. Oh, sorry, it's 12.5. Okay, 12.5%. And yeah, look at this. You know, it's giving a very different number here. It's 10.71% instead of 12.47. And I think I know why there is this difference is basically the annualization effect, as in we have to take the average assets when we are doing this calculation. But because SG Finserve is expanding so rapidly, even a gap of 6 months, the difference between the opening loan book and the closing loan book after 6 months is quite wide and varied, which obviously makes a difference when we are calculating these numbers. Anyways, the point I want to make is that right now, the equity multiplier is at 2.77, and the management wants to take it up to 3 times by the end of FY27. So essentially, the equity multiplier goes up from 2.77 to 1 plus 3, that is 4. And as a result, the ROE, which is nothing but a product of the ROA and the multiplier, can potentially move up to 18% in a few short years from now. At least that's the working theory. DuPont analysis, it's a term that I used just a bit earlier. Well, one of the things it allows us to do is to understand the interplay between ROE and ROA. For instance, if the ROE is low because the ROA is weak, then it usually means the spreads are very tight, or else the OPEX is on the higher side, which is not the case with SG Finserve. ROE is low because the leverage is low. Yeah, this one seems to be more likely, as it's commonly seen amongst young lending operations which are generally equity heavy. But of course, as the proportion of leverage increases and the business stabilizes, the ROE and the ROA do align with the business performance. So these were some of the metrics that one should consider when evaluating SG Finserve or any NBFC for that matter. I have to be honest, I'm a bit kacha in terms of my evaluation, my understanding of the evaluation of financial institutions. So if I've made a mistake, do point it out to me. But I'm actually quite happy I did this exercise because I have learned a lot in the process, and I hope you have as well. All right, so we've done a couple of things so far. We first looked at the USP of SG Finserve, and they have a bunch of them. And secondly, we looked at important metrics that one should consider when evaluating such a company and where SG Finserve currently stands with each of them. I think now it's time we need to look at some of the itchy points. So here are a few which I could discover. Let's start with the management, and a lot has happened in the last 2 months. In fact, the 13th of October was a bit of a pickle for SG Finserve, with the CEO Saurabh Dhawan, who was with the company from the start of operations, resigning on that day. And not just the CEO, Sahil Sikka, the CFO and COO of the company, also resigned on the very same day, the 13th of October, to pursue other financial opportunities. And unbelievably, the internal auditor, Prince Shukla, उन्होंने भी resign कर दिया, and there are no prizes for guessing the day that event also happened. As one might expect, every analyst who was on the latest earnings call was keen to understand this purge in management, to which the outgoing CEO says that these were all coincidences, that the transition was already planned and outgoing executives would stay on for another 40 to 50 days to facilitate a smooth handover process. I'll leave it to you to make your own assessments of what's happening here, but if you've been tracking this company for a while, then the fact that Mr. Sikka and Mr. Dhawan were on their way out should not come to you as a surprise, with them having sold many shares in the company for the past few months. So that's that. And now let me come to another unpleasant observation, which is a spate of downward revision in targets by the management. Please recall what I said earlier, that the company is targeting 3,500 crores of AUM in FY26. Well, that's what the management said in their latest Q2 transcript. But if one looks at the investor presentation of the very same quarter, the number quoted there is 4,000 crores. Because 3,500 is not 4,000, there's clearly a mismatch there in terms of internal expectations. Even in terms of net profits, the initial guidance for FY26 was of 150 crores, but the first 2 quarters of the year has yielded only 25 and 28 crores. So that's 53 crores, which means doing an additional 97 crores over half a year seems more like an impossibility to me. However, the management never corrected this guidance in any of the quarters, and neither in the opening remarks that they gave in the current earnings call. And only when some of the analysts pressed the management did they accede to the fact that 150 will not be possible, and this year's PAT will be more like 120-125 crores. The reason for this was attributed to a slowdown in the anchors businesses across building, metal, auto, FMCG and other sectors, which is fine, but the fact that the management did not present this material information on their own shows a bit of willful negligence on their part. Other than this, there have been a few more misses by the management, so it kind of gives me the impression that this management, the earlier management, has this tendency of exaggerating the numbers. So even that 6,000 crores of loan book target, which was given for FY27, I think I'll take that also with a pinch of salt. All right, let's go to observation number 3. And this time I want to check out the yield numbers. Yaad hai na sabko? This was 12.4% in Q1 and had dropped to 11.5% in Q2. Now, the reason for this drop, as explained by the management, is the onboarding of large corporate anchors, namely Tata Motors and Mahindra, who were brought in at reasonable discounts with lending yields in the range of 11%. The management says this was a conscious decision on their part to secure significant volumes, and they don't foresee them offering such discounts at this kind of a rate. All this is fine, but do remember that SG Finserve needs to maintain an yield of 12 to 12.5% to keep that spread of at least 4%. So discounts, in case they give anything in the future, I think it is important to keep a note of that. All right, so as you've seen, there are some good, bad and ugly things that we have discussed in this presentation. Let's do a quick summary. So SG Finserve focuses on supply chain financing and has dispersed over 52,000 crores since inception. It's backed by the APL Apollo Group with corporate guarantees and all, allowing it to borrow at competitive rates. This cost of fund is currently around 8.5% for them. The company has maintained a nil gross NPA track record since inception. thanks to its anchor-backed model and stop supply arrangements. It has strong tech, which is becoming a sort of competitive advantage, and it has a strong anchor base, the top industrial and manufacturing houses across sectors, as the company continues to diversify beyond APL Apollo. In terms of financials, the loan book is currently at 2,800 something, with a target of reaching 3,500 crores this year and a supremely ambitious target of 6,000 crores by FY27. The current ROA is 4.5%, which is fairly good, but because the gearing, the equity multiplier is a bit low, we find the company's ROE at around 10% currently, with a target of reaching 18% eventually. And finally, in terms of challenges, I definitely don't like the fact that the company tends to offer aggressive targets only to revise them downwards at the last moment. We've seen that with the loan book and their PBT and PAT guidances. The next earnings call will be a crucial one, as it gives us an opportunity to understand how the new management plans to navigate the ship. Normally, and this is generally from my experience, that whenever a new management comes in, they get the license to disown what the previous management has done in terms of targets and plans, which can be a slightly unpleasant sight for many of the existing shareholders of the company. By the way, if you're wondering what the former CEO, Mr. Sarab Dhawan, is up to, this news came in just on the 19th, so day before yesterday, that he's been appointed as the CEO of PSB Exchange, which per my understanding is yet another platform that's focused on supply chain financing. अब ऐसा तो होता रहता है, can't do much about it, but what we can control is our ability to track, monitor, and get better at evaluating such companies. This was my first foray at looking into an NBFC, and I'm going on a limb here. I'm not recommending anything, but personally, after doing all this research, it seems that SG Finserve is completely at the edge here, and it has to deliver absolutely flawless execution and has to achieve all its guidances to avoid getting a derating in the future. That's just my assessment of this company. And if you have a counterpoint, or if you support my views, or if you have any questions, please drop it in the comment section below. I love to read all your comments, and I do respond to most of them. I hope you liked my attempts at looking at an NBFC, and I wish you the very best. Bye-bye.